Good afternoon, everybody. This is Bob Iaccino from Path Trading Partners. I'm here with my co-founder, Mike Arnold. And as always, thanks to Nadex for giving us this forum. Today we're going to be doing trading at the money Nadex Spreads, which we've done before but bears repeating. There's a lot of information in this particular presentation. But one of the things that's lost on people sometimes is there are times to take spreads, Nadex Spreads, at different stages in the pricing structure, and that's one of the ones we're going to go into, which is at the money. So before we begin, as always, let's go over a quick statement, risk statement. I always like to point out that we call it a statement and not a disclaimer, because we actually believe in what I'm about to read. This presentation is for information purposes only and does not constitute investment advice nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading could be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. It's that last part that we really want you to pay attention to, that even in the much safer limited risk environment of the North American Derivatives Exchange, or Nadex, you still have to be careful with the amount of money that you place at risk. And you have to be careful that that is money that you can't afford to lose if it is one of the trades, even in a high probability system, that loses, because there are always losing trades. If you've chosen trading as a job, as a hobby, as an income augmenter, you've now made risk and loss a part of your life. It's unavoidable. Who is Path Trading Partners? Well, we're a trading and education firm, and our mission was to form a trading firm that educates, supports, and provides seed capital for traders who are committed to probabilities, discipline, and long-term trading success. This is achieved by following the correct path. We are not high-frequency traders, and we are not day traders. What we are is a firm that believes in long-term success in trading, covering time frames dictated to us by products, markets, and price action. Key part of that sentence, the market dictates to us what we do. We have strategies, and the market allows us to see whether those strategies are effective in that particular time frame or not. And if they're not, one of the smartest things we do all day, all week, all month is skip trades that aren't actually there within our method. So who is Mike Arnold? Mike's a 24-plus year market veteran who's been teaching traders online and in person for 10-plus years. This is the part where I like to say Mike is a professional devil's advocate. He is and was a strategy and development consultant to multiple hedge funds. Mike is the guy they call in when they come up with a new trading system and they ask him to find the holes in it. They basically ask him to break it, hence the professional devil's advocate. He's a former options market maker on multiple exchanges. Some of those exchanges were in Chicago, New York, Switzerland, and Canada, and he's the current head of technology and trading systems development for Path Trading Partners, as well as being my co-founder. That's me in the corner there. I've spent the last 24 years in the commodities, futures, and forex markets. I've been teaching and mentoring traders both live and online since about 2002 to date. I've had about 5,000 students go through my turnstile, so to speak. I've been an analyst, a prop trader, a fund of hedge funds principal, and a member of the investment committee at that fund of hedge funds. And I think that's where I provide value for you guys, as well as having been a risk manager at several different prop firms. I have appeared on every financial news station and a couple of the regular news stations, including CNN, and I continue to appear about 5 to 10 times per month. I've done well over 700 interviews at this point on various topics. As a matter of fact, I will be on Bloomberg tomorrow morning. I think it's 7:10 Central Time, or maybe 8:10 Central. I'm not really sure, but it's one of those two times. It'll be Bloomberg Television. All right, let's do a quick review. In prior classes, we covered the concept of moneyness and classifying a spread as either in the money, at the money, or out of the money. We taught the concept of spread premium and looked at how to determine both intrinsic value and extrinsic value, and we taught the Greeks what they are and how they apply to Nadex spreads. If you need to learn these concepts, please watch the recordings of our prior Nadex classes after this webinar. And actually, I'm going to show you exactly where you can find those. You go to, let's take it back one notch. You basically go to nadex.com, okay? And then you go down to the Learning Center and you look for webinar archives. The easiest way to find our stuff is to filter by presenter. You go into this filter by presenter, click on Path Trading Partners, and here are all of the recordings of webinars that we've done. And if you go to page 2, for example, here is spread moneyness right there. Understanding option moneyness with Nadex spreads. And you'll see a lot of the Greek ones, and here's trading at the money Nadex spreads, which we're about to do live for you guys. So, after learning the Greeks, most traders wonder how they can effectively translate that knowledge and information into useful and actionable trading information. This is what we're going to do when we look to trade at the money Nadex spreads. However, first, we're going to do a very brief review to ensure everyone is on the same page. So what is at the money? Well, we refer to a Nadex spread being at the money when the price of the underlying is trading at the floor price when trading the spread long, and conversely, if the price of the underlying is trading at the ceiling price when trading the spread short. So, if the S&P 500 is trading at the floor price of 1900, in this particular 1940, 4:15 p.m. Eastern Time expiration, this is a long Nadex spread. If you're taking this long, we consider it to be at the money if the underlying price, the S&P 500, is currently trading at 1900. You could think of it as a place where intrinsically it's starting to become profitable. Okay? This is the starting point for a long to make profits at expiration. Okay? You're going to see this shaped curve a little bit later in the presentation as well. This is at expiration. And the floor price on a long is considered to be at the money. Conversely, if the S&P 500 in the same spread is trading at 1940, then the spread is considered to be at the money if you're going short the spread. Again, where would you start to make money in this particular one? Well, if you're going short the S&P and the S&P is at 1940, well, then 1940 is where this particular spread would begin to bring in intrinsic value into the pricing. All right, and I'll talk about that real quick. What makes up the Nadex spread premium? Well, it's intrinsic value, which is what would the value be at expiration given the price of the underlying right at this moment. Whether that's expiration or not, right at this second, what is the value of that particular option if it were to expire right now? So in the example of the 1900 to the 1940, if the underlying is at 1905, and all of a sudden Nadex announced we're expiring everything right this second, what would that be worth? Be worth $5, right? That's intrinsic value. Extrinsic value is the time value. Okay, and sometimes that can add to or take away in the case of Nadex products. But we'll go into that a little bit later. Let's do a quick review of the Nadex spread Greeks, and we can apply these Greeks to Nadex spreads. The definition of each Greek is as follows. Delta is the sensitivity of the spread price to changes in the underlying. Okay, the underlying price moves all day long. How sensitive is the option to that movement? That's the delta. Gamma is the sensitivity of the delta to the price change of the underlying. The delta also changes as the price change of the underlying moves. How sensitive? Is it changing rapidly or is it changing more slowly? That's what gamma measures. Theta is the sensitivity of the spread price to the passage of time. What's inevitable? Time is going to pass. The option is going to move closer and closer to expiration as every minute ticks off the clock. Okay, is it moving quickly, the price of the option? Or is the price of the option only just sort of ticking away here and there? That's measured by theta. Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. So how quickly is the spread price moving as vol increases? How quickly is the spread price moving as volatility decreases? That is measured by Vega. And rho is the sensitivity of the spread price to changes in the interest rate. We will not be looking at rho since we're trading spreads on a short-term basis, and rho will not affect the price of the spread the majority of the time. You're most likely not going to be in a position the second that medium-term or short-term or long-term interest rates move affecting your option. That's just not going to happen often enough to cover rho and to worry about what rho is in this particular case. But it does measure the sensitivity of the spread price to the interest rate changes. So, take one slide back and go back into extrinsic value again, which we said is time value. Well, what goes into the time value? Well, a few things. The time until the spread expires, which is theta, as we just mentioned on the prior page, and the volatility of the underlying, which is Vega. So what makes up the extrinsic value? By the way, also changes in the interest rate, which is rho, but again, we grade that out because that's not something that we need to cover in the short-term world of Nadex spreads. So time until spread expires, theta, and volatility of the underlying, Vega, those two components go into deciding what the extrinsic value of the particular option is. So in this session, we're going to examine in depth how time, theta, volatility, Vega, market direction, and momentum affect Nadex spreads when trading them at the money. This session will only focus on trading the Nadex spreads at the money. Other classes will focus on trading them at in-the-money locations. So again, go back to that 1900-1940 spread. This is focusing on it if the underlying is at 1940. Okay, not 1940-05. I'm sorry, 1945, not 1938, but 1940, and that again would be the short one. We will also mainly be focused on trading the spread from the long side for the point of simplicity as well as time. Although all the information we present directly applies to trading the same spreads at the money from the short side. So the information we're about to give you applies to both long and short trades. But again, in the interest of time, we're just going to cover long trades here to make it a little bit easier to understand, and you could apply the same information to short trades as well. Many traders look to trade spreads at the money or even out of the money because they look directly at the reward to risk and see that they can potentially get large reward for very little risk. Now this is true, but the trader needs to understand the market conditions that are appropriate to initiate these kinds of trades. Just trading a spread because it looks like you can make a lot of money without a lot of risk is not a sound strategy. I'd be guessing that a lot of people, when you first started, that are listening to us in this webinar right now, that was almost all you looked for. You said, okay, I want to get my reward to risk right. Okay, I want smaller risk than reward. But did you know that there are times when that is not the smart way to trade these spreads? Once you understand the market conditions that can be beneficial to putting on a Nadex spread when it is at the money, you will be one step closer to becoming a complete spread trader. So, let's just, for the purposes of this, before I introduce Mike here, remember I mentioned you're going to see this particular static and straight curve here. Again, this is the US 500 2000 to 2010 Nadex spread. And this blue line represents where price is at expiration versus where the underlying is. Okay, so you can see right here, if it's at 2000, remember, we're talking about a long spread, this is the point of being at the money. Anywhere up this curve is now in the money, and we're only talking about at the money. You can be pennies away from it, but Mike will get into that. The green curve here represents the price with both intrinsic and extrinsic value in it because there are 120 minutes left in this particular option. Okay, so at the money at expiration, it's worth nothing. Now with 120 minutes left, it's worth a little bit over $2. And you can see that right there. So at the money is a $2 value here with 120 minutes left, again, given volatility not moving. That's an assumption that's made in here. So let me turn it over to Mike now, and he can go into the rest of the information, and I'll join you guys again in a second.
Great, thanks Bob. Thanks everyone for being here. So again, as Bob just covered this very well, we're looking specifically at the money, and we can be on either side of at the money. We're still talking in this vicinity. Remember, if it's slightly above at the money, you're going to have intrinsic and extrinsic value, but still the majority of it's going to be extrinsic. If you're slightly below at the money or anywhere below at the money, this is all extrinsic value, meaning it's all time and volatility value. So, when trading the Nadex Spreads exactly at the money or anywhere below at the money for a long, there is not any intrinsic value. It's all extrinsic value. Let me jump back to the slide. So if we're right here, this is a very important concept to understand. If we're right here or anywhere in this area, all this value with 120 minutes to go or whatever time to expiration is extrinsic value, because the spread anywhere at or below 2,000 in this example, if it expires at or below, it will expire worthless. So therefore, it is all an extrinsic value. It's worth nothing intrinsically. If you are trading a spread slightly below the at-the-money price, there's also only extrinsic value. And if you're trading a spread slightly above the at-the-money price, then there will be a little intrinsic value, but it will still mostly be extrinsic value. When we jump back here, so if we're above this line, not at it, but above this line, the farther above this line you get, the more intrinsic value it has. For example, if we were trading at 2001, which is above the at-the-money price, we'd roughly have $1 of intrinsic value, because that's what the spread would be worth at expiration, and the rest of it would be time and volatility value, or extrinsic value. So with 120 minutes to go, maybe the spread is trading, just under 3, maybe $2.80. $1, that's intrinsic value. The other remainder is extrinsic value. Since all the value is extrinsic value, right when we're at the money, time is working against the trader. So if price action is stagnant and not moving further into the money, then every minute that passes hurts the at-the-money spread trader. Time is not your friend. This is especially true as the spread gets closer and closer to expiration. Spread value in theta. Remember, theta is the time decay Greek that Bob mentioned earlier. Okay? Theta can help or hurt the spread trader depending on where the trader is trading the spread. But as long as the underlying price remains close to or at the money, time is working against the at-the-money spread trader. Therefore, theta is decreasing the extrinsic value every minute that passes. As the spread approaches the expiration time, the time decay increases rapidly. That's one thing you're going to want to realize. Initially, if you have 2 hours to go or 90 minutes to go, theta, if you're at the money, theta is still working against you. But it's not, you're not going to notice it as much. But as you get really close to expiration, that theta gets very, very large, and that spread can lose extrinsic value very quickly if it remains at the money. So here's sort of an example of the change of a spread price versus time, and this is given a volatility, a certain implied volatility. We could call it, 25%, whatever, and that is not changing. The only thing that's changing is time, and if we were right here at price, at the money, so 120 minutes to go, the spread's roughly worth about $2.40. 90 minutes to go, it's roughly worth $2. So you can see how with 30 minutes that passed, if price didn't change, if price didn't really move, that's your time loss, because it went from 230 to 2. So it lost 30 cents of extrinsic value. 30 more minutes passes, it goes from $2 to, let's call it $1.75. So that would be, or $1.70. That would be more time decay. You would have lost that additional value from the passage of time. Now from 60 to 30, you can see how it starts accelerating even more. Maybe it's like 270, and now it's only, 170, and now it's only worth maybe 130. So now it's lost 40 cents in that 30 minutes. And you can see how that keeps going until it expires worthless if the price does not move. So this is all the effect of time decay. And again, we're not changing the implied volatility, and we're assuming that the spread is still remaining trading right around at the money. Here's what this theta curve looks like. If we were going to graph out the theta Greek, okay, and this is with a certain time frame and a certain implied volatility, we'll just call this with 15 minutes to go. At the money, you can see this again is your horizontal axis, shows where you're trading. We're trading right at the money. You can see the effect. This is negative. So every minute that passes is decreasing the value of the spread because it's removing the extrinsic value. Okay? And you can see how it's most negative right at that money. You go below at the money, out of the money, and it gets less and less negative, but it's still negative because it's going to still be taking away from that extrinsic value. You're still getting time decay. Right above at the money, it might be worth something intrinsically, but your time decay is still going to eat away at the extrinsic value. So the extrinsic value is going to keep diminishing the closer you get to expiration. And you can see if you've watched any of our other spreads, you can see we have a null point, which is really the halfway point between it, where the time decay is 0. And I talked about it, I'll just touch on it, and we have past webinars we've done on this. But you can see as you get up above, for a long spread, up above the null point, the time actually starts working in your favor. So every minute that passes, you can capture time value. But the focus of this webinar is at the money in this region, and time is hurting you, and it's most negative at the money. That's what this graph is showing you. Now, theta also changes versus time. As I said, remember, it gets more and more significant the closer expiration. So with 120 minutes to go, theta is still negative. You can see it negative here. 90 minutes to go, it's a little more negative. 60 minutes to go, more negative. So it's hurting you more if it remains at the money. You can see how it gets more and more significant as time passes. With 5 minutes to go, you can really see how the effects of time decay kick in. Look at the difference between 15 minutes and 5 minutes. So you only have 10 minutes past, but look at the rate of change. This is showing the rate of change of time decay. So that's why you can see if you're going into expiration and your spread's still at the money, slightly below the money, you're going to see pretty much that evaporate unless the spread starts moving directly into the money and, you know, really building up that intrinsic value. So now let's tie this to some market conditions if you're going to be trading at the money spreads. It's best to trade at the money spreads during busy market conditions. At the money spread should not be put on in quiet or stagnant market conditions, especially close to expiration. Why? Well, if it's not moving, if the market is not moving and you're putting this on, you're just going to experience all that time decay. And you do that really close to expiration when that time decay is really big, essentially that spread's going to, you know, if the market's not moving, all that extrinsic value you paid for is going to disappear. If the trader expects market conditions to get busy and is trading a spread with significant time to expiration, then it's okay to establish it during quieter conditions. Let's say, you know, you're trading a 2-hour expiration spread, and the market, you know, the busy times, like the S&P is going to open in 30 minutes or something. Fine, because you're going to get some time decay if it just sits there, but you're only going to get a little. Remember on this slide, with like 2 hours to go or even 90 minutes to go, you still experience some time decay, but it's not significant. Well, if you're putting it on really close to expiration, it could be significant. So during quieter market conditions, if you expect the underlying volatility to pick up, it's fine to establish it because you're not getting a ton of time decay. That's because you're also going into a busy time when it could be moving. So that's okay. But do not just put it on like after hours in the currencies. You know, like at 6 p.m. Eastern time in the currencies, most evenings, they're not moving that much. So that would be a really bad time to put on an at-the-money spread because you're not going to get a lot of movement and you're going to experience that time decay, and that's working against you. So, for example, a US 500 9 to 11 a.m. spread being put on between 9 and 9:30 since the futures market opens for U.S. markets at 9:30 a.m., which creates busy market conditions. That's an example of when, all right, it might be quiet right before the open, but you might be putting on this 9 to 11 spread. You might be putting it on at 9:28. Okay, you're expecting it to start picking up in the next few minutes. That's fine. Busy market conditions can lead to a couple things. First, it can lead to trending market conditions, which are beneficial to ATM spread traders. You want, especially trending, don't want it trending against you, you want it trending in the direction you are trading. So if you're long, you want it trending up. If you're short, you want it trending down. But trending market conditions are going to, for example, a long spread, I establish it at the money, the market's trending, that's going to give me that intrinsic value. That's going to move it further and further into the money, which benefits me. Second, it can lead to stable or increasing implied volatility, which is also beneficial to at-the-money spread traders. The trader does not want price action to remain at the money for too long or move out of the money for an extended period of time, especially as time gets close to expiration. The trader needs to have a moderate to strong directional bias, which will take the underlying further into the money. I just alluded to implied volatility. Let's get into that concept. Remember, implied volatility is part of the input that leads to the amount of premium you're paying for extrinsic value. So an increase in underlying volatility can lead to an increase in the implied volatility of a spread. This is beneficial to the at-the-money or slightly out-of-the-money Nadex spread trader if the price action remains close to the at-the-money strike price. The at-the-money spread trader does not want the implied volatility to decrease because it hurts the at-the-money spread trader. As time approaches expiration, the effects of volatility decrease, though, so keep that in mind. Every 1% increase in implied volatility increases the price of the spread. Let me show you how that will look graphically. But conversely, every 1% decrease in implied volatility decreases the price of the spread. So this is a graph of Vega. All right, before we graph Theta, this is Vega. You can see here's at the money. So out of the money is here, at the money here. We're positive. That means every increase in implied volatility actually adds to the value of the spread. Why? Because it adds to the extrinsic value of the spread. You can see here above the null point and beyond, the effects of Vega have the exact opposite. But we're focused on this for this webinar. So implied volatility increases help us, and this is we're assuming at this graph is showing an implied volatility of 35%. And this is also holding time static. Let's take a look at that at the money spread, which is changing the volatility. So now we're right here, the underline's not moving, and time is not moving. We've frozen time. The only thing we're changing is the implied volatility. So you can see, as if we initiate the spread when there was 10% implied volatility, and implied volatility went to 15% with nothing else changing, the value of that spread would increase. That's what I'm saying. Increases in implied volatility help you if you're at the money spread trader. If it goes to 25%, it increases more because this is increasing the extrinsic value of the spread. We go to 35%, it increases even more. The opposite happens, though. You do not want to be in decreasing implied volatility conditions. Remember, I said stable. Stable doesn't affect you. If it stays at 20 or 25%, time's still going to affect you, and the underlying is going to affect you, but the implied volatility isn't going to change the intrinsic or extrinsic value of this. However, if you initiate this spread in high implied volatility conditions, like, for instance, 35%, and then implied volatility started dropping rapidly and the price was not moving, your spread price is going to decrease in value pretty rapidly depending on how much implied volatility were to fall. So maybe you put this on expecting a crude oil report to come out. The report comes out and everybody's like, oh, that's what we expected, and crude just doesn't move, and the market makers decrease the implied volatility because they had it higher because they expected the report to come out. So maybe it was up around this 30% level. The report comes out, it's no big deal, the market just goes dead, it doesn't even move off this report, and now they start ratcheting down the implied volatility in their models. That spread price is just going to decrease in value because they're taking away some of that extrinsic value component. Here's the graph of Vega versus time. What I really want you to see is implied volatility changes are going to be much more dramatic to your spread price with more time towards expiration, meaning 120, 90, 60, here's the effects up here. As you get down to very little time, it still has effect on your spread price, but not as much. Why? Because there's not as much time for different outcomes. So the price of the extrinsic value decreases. Let's take a look at delta. It's important that the trader understands the delta of trading a spread at the money. The delta is the amount the spread price will move in relationship to a 1-point move of the underlying. So if the delta is 0.5, then the spread price will increase or decrease half as much as the price of the underlying. It is interesting to note that the passage of time does not have much effect on the delta when trading the spread at the money. This is something you can just remember. The delta remains close to 0.5, and I'll show you this graphically. If the spread is trading just below the at the money, then the delta will decrease rapidly as the expiration time approaches. If the spread is trading just above at the money, then the delta will increase rapidly as the spread approaches expiration. An agile trader trading a spread at the money when price action is trending towards the null point can take advantage of the rapid increase in delta. So here's our at the money. You can roughly see, depending on what time you are, it changes a bit, but it's right around this upper point, 4, 5 to 5 range, no matter what time you have to expiration, right at the money. Now you notice slightly in the money. As you get closer and closer to expiration, the delta changes rapidly. A delta of 1 means the spread would be moving the same amount as the underlying. So you can see above here, you can, with less time to go, if you catch a trending market and can put something on at the money, the delta can really kick in and the spread will increase intrinsically very rapidly as it gets close to expiration, as long as the underlying is trending further in the money. However, if you drop below this at the money price, you're out of the money. As you get closer and closer to expiration, the delta will start dropping off rapidly. So if it's remaining just out of the money here, as we get really close to expiration, your spread has very little delta. Why? Because its probabilities are that it will still expire out of the money. So the underlying has to move a lot farther and take it in the money before you generate the delta. Non-optimal conditions. We have just outlined some conditions we are looking for to consider entering an at-the-money Nadex spread. Let's rephrase them and look at what the non-optimal conditions would be. We are not looking to trade the at-the-money spreads in quiet market conditions with very little movement. That's something you can remember. That should be in your notes. We are not looking to enter these spreads with very little time left, especially with very little market movement. Why? That theta is really working against us, decreasing that extrinsic value, and the spread can lose that extrinsic value very rapidly close to expiration. Significantly decreasing volatility, it should say implied volatility, combined with stagnant market conditions hurts the at-the-money spread trader. You do not want that implied volatility dropping rapidly against you, especially if the underlying's not moving. Then you have implied volatility working against you, time working against you, and you're in non-trending market conditions. Those are the 3 things you really need to avoid. And if you're in a situation where all those 3 things are happening, then you should be getting out of that spread. Examples of non-optimal conditions. Early evening trades in currencies and usually in equity, indices, and commodities. I mean, if there's news out, if there's something going on, that's really driving those markets, that's a different story. But generally, after hours conditions in the early evening, things are trading in a tight range, and you don't want to be looking to put on at-the-money spreads. You're better to be looking to put on, in-the-money spreads where you can capture that time decay. So if you were long, it'd be somewhere above the null point. A long time before a major report release. For example, putting on an at-the-money spread at 12 p.m. that expires at 2 p.m. when there's a major Fed announcement expected at 2 p.m. Why? Because generally the market is going to get quiet. Implied volatility will be going up, but remember, when you're close to expiration, that implied volatility does not affect the spread price that much. This spread's going to expire right at the announcement time. So the market can go really dead before that and not move. In that case, all that time value, all that time decay is working against you, and you've purchased something that is not generally going to work for you. So you've bought something that diminishes in value every minute that passes, and the market will most likely not move drastically until after that major report release.
Just want to go back to that last slide real quick, because I think before we go into the optimal conditions, which are obviously going to be pretty much the opposite of the non-optimal conditions, this last one's a very important example of having a strategy before you just come out and trade on reward to risk. If you're putting on an at-the-money spread at 12 p.m. that expires at 2, when there's a major Fed announcement that's expected at 2, and you don't know that as part of your strategy, or as whether it's the optimal or non-optimal time to put on an at-the-money, well, guess who does? It's the market makers, and it's the people trading the other side of that. So you're going to look at your Nadex spread ticket, and it's going to show a really skewed reward to risk, with the reward seeming really high. Okay, and that's because it's not going to move for the 2 hours like it would if there were optimal conditions on that particular kind of a spread. So this is a really good example of having a strategy going in, and why we teach these particular webinars for you guys for Nadex for free, is getting you guys to understand that you have to go into it knowing these things. You don't have to know exactly what the delta is, or exactly what the change in the theta was, or if whether delta's at 45 or 50 right now. You just have to be aware of these kind of things, because the people trading against you are aware of it. So optimal example, where here are some optimal conditions when a trader may consider an at-the-money spread trade. A trader has a strong directional bias with expectations of stable or rising volatility going into busy market conditions. Let's review a path trading setup that would be suitable for trading at-the-money Nadex spread. So again, a path trading setup, you're not going to understand why we would have placed this trade. That's the kind of thing we teach at Path. We teach you how to find these on your own. But let's just take a look at it, because we do need to have an example. All right, here is crude breaking down from congestion. You see congestion up here, and crude is kind of breaking down through a trend line. We've got a trade triggered at 10 a.m. with a close beyond a path trigger trend line, okay, which is this one right here. Momentum heading to new highs as price breaks to new lows. We have a 3-target move based on path reversal pattern and clear path targets. The targets of this particular trade in crude, again, are 32.65, 32.05, and 31.75. And we have rising volatility on the sell-off. If you've ever watched the VIX with the equity markets, if you watch CNBC or Bloomberg or any of these stations, they'll tell you it's called the fear index, because as equities are falling, volatility tends to be rising. When price begins to move quickly, volatility tends to be rising. So in this particular case, we have a 3-target trade, again, a strategy setting up to take a Nadex product trade. So here you have a screenshot of the ladder at this particular time. And we have a 31.75, 33.25 spread. That's got a 32.99 bid and a 33.05 offer. We look to enter this spread on a pullback to a key reversal zone with the 31.75, 33.25 spread at the money. Okay, remember, 32.25. We're going to trade this short, right? And the upper end of that is 33.25. So you're right at the money for a short trade on this particular setup that we have. So a quantity of 3 in order to achieve our 3 targets on the 31.75, 33.25 spread were entered short at 32.99. Again, right at the money. 1 cent outside of being exactly at the money. So the first target was reached and 1 spread was closed. We exited 1 spread after the first one was reached. The second target was reached and the second spread was closed out. And the final target was reached and the third spread was closed out. Again, we had a strategy in place. We looked to trade this at the money considering the conditions that were present at that particular time. We expected rising volatility and rapid movement. So that's a good time to place an at the money spread. We entered the 33.25, okay, exactly at the money with the underlying, and the move down toward our 3 targets caused us to have a profit on each one of these, and we always exit trades at targets. We don't necessarily let them expire. As a matter of fact, we often don't let them expire unless there's a few minutes left and you're right there. But otherwise, we take profits at our targets because it's the underlying strategy that is what dictated what we're going to do, as I mentioned in the introduction of Path Trading Partners, that we let time frames be dictated to us by markets. So when we get our targets, we cleanly exited the trades. So in this webinar, we covered various aspects of trading at the money Nadex spreads, or ATM. We examined how some of the Greeks affect the spreads, and we also looked at the optimal and non-optimal market conditions, which can help a trader determine when to trade the spread at the money. As always, you'll probably need to review this information multiple times and then determine how this information can work to further help your successful trades at the money spreads with your trading strategies. Again, you have to have a trading strategy behind it in order to know, okay, I'm expecting this type of a move within this time frame, doesn't have to be exact, and then you check the conditions and say, are these better conditions for at the money, in the money, or out of the money, based on the 3 webinars that we showed you. So next time we'll be looking at trading spreads at the null point. We'll again look at the market conditions that are beneficial and detrimental to trading spreads at the null point. And it'll be very helpful to a trader to again review the Greeks and the various characteristics of them and how they apply to Nadex spreads. Again, the Greek webinars are in the same place. You go to nadex.com, go to those webinar archives, and just filter by Path Trading. You'll see all the different ones. And I believe this recording will replace the old one. There's a little bit of new information in here, but not much. So it'll replace the old one, but you can go back and watch the other ones to kind of catch up on what we're talking about before our next webinar next Tuesday. So if you could, we're going to stay and take questions if you have any. If you could, like us on Facebook, visit us at pathtradingpartners.com. There's free stuff for you guys to sign up for. And listen to our podcast, The Money Path, which can be found on our website. That's one of my favorite things to send you guys. But again, join up with Path. There's no purchase necessary. You can watch all the free stuff on there, and then hopefully you decide to learn a strategy or two. But if you don't, we're happy to have you. Any questions from anybody? Not seeing any so far, but I'll wait a few minutes. Again, pathtradingpartners.com, and go to our Facebook page. Follow us on Twitter at @path_trading. And again, the Money Path, which is right there on the website under latest news. You can listen to the latest podcast. I think they're pretty entertaining and informative personally. Not seeing any questions come through. And there's one. As it was a holiday, these Monday does oil rig inventory. I'm not sure what you're asking me there, Alex. Does oil rig inventory come out on Thursday? I'm not sure what that has to do with at the money spreads, but all you have to do is go to bakerhughes.com. Baker Hughes is who puts out the oil rig inventory. Should be out on Friday. If anything, with the Monday, they'll push it to the next Monday. They won't let it out early. Friday we're open, so I don't know why it wouldn't come out on Friday again. But you can go to bakerhughes.com. Baker Hughes is who puts out the oil rig inventory. Again, you can ask any question you want. I'm happy to answer it if it's something I know about, but we'd love to keep them to the topic. You're welcome, Alex. No problem. All right, we've lost about 10% of the people that signed up for the webinar, so I'll wait maybe one more minute, see if anybody's typing anything, and then I will bid you guys a farewell from me and Mike. All right, guys, Nadex, thanks for being here. Cheers, everybody, and we'll speak to you guys next Tuesday, same time. Thanks again, everyone. Thanks, Mike.